Hello and welcome to this video in which I summarize the basic concepts of impairment of assets as described in IAS 36. I am Silvia of CPDbox.com, the website with loads of articles, videos, lectures, discussions, and other materials for accountants. So if you need to learn some accounting concept, pass your exam, or get answer to some of your questions, you're very welcome to check out CPDbox.com. So IAS 36 was issued in 1998 for the first time, and it has been later amended a few times. Its objective is to ensure that assets are carried at no more than their recoverable amount, and to define how recoverable amount is determined. The rules of IAS 36 apply basically to all assets, of course, with some exceptions like financial assets, inventories, and you can see the full list of exceptions on the screen. And on the other hand, this is the list of all assets that IAS 36 applies to, and you need to recognize and measure the impairment loss on these assets in line with IAS 36. So let's firstly look to what the impairment stands for. An asset is impaired when its carrying amount exceeds its recoverable amount. And carrying amount is an amount at which an asset is recognized after deducting any accumulated depreciation and amortization and accumulated impairment loss. So that's what you see in your books or accounting records. Recoverable amount represents a higher of assets fair value less cost to sell and value in use. So if carrying amount is greater than recoverable amount, the difference between the two is impairment loss. How shall we find out that some of our assets are impaired? Well, each entity who wants to comply with IFRS has to do some work at the end of each reporting period. So it's necessary to assess whether there is any indication, either external or internal, that an asset might be impaired. And you don't need to perform testing each year, but you do have to assess indicators. But if there is an indication, then you also must perform the test. Of course, there are some exceptions to this rule. For example, intangible assets with indefinite useful life, such as trademarks or goodwill, and these assets basically needs to be tested for impairment annually. What shall we consider when assessing indicators of impairment? As I have already said, there could be external and internal sources of potential impairment. So you can see the list of external sources of any potential impairment on the screen. And I'm quite sure that nowadays in these COVID times, there will be a lot of external indicators of impairment, right? Now let's take a quick look at internal sources of information to look at. Things like obsolescence, physical damage of an asset, or significant internal changes like restructuring taking place in your company might indicate that you have the assets impaired. And again, I warn you, in this COVID time, it's also probable that you will find some indicators of impairment in internal sources as well. So if you find that there are some of these indicators of impairment, you need to calculate impairment loss as a difference between carrying amount and recoverable amount. How do we figure out recoverable amount? Well, it's greater of assets or cash generating units fair value less cost to sell and value in use. And here I'd like to say that it's not necessary to determine both of them, or at least not always. Just one of them might be sufficient to determine, because if just one of these two amounts is higher than assets carrying amount or book value, then there is no impairment and it's not necessary to estimate the other amount. So you save a lot of work. Also, very often there is a situation when there is no basis for making reliable estimate of fair value, especially when the asset is not traded in an active market. And in this situation, value in use might be considered as assets recoverable amount. Now let's explain how to determine fair value less cost to sell. And here you need to look at IFRS 13, fair value measurement, to set the fair value of the non-current asset. And I have posted a summary of IFRS 13 on this channel as well. Cost of disposal include legal costs, stamp duties or similar transaction taxes, cost of removing the asset or bring the asset into conditions suitable for sale. Now let's take a look at value in use. Value in use is the present value of the future cash flows expected to be derived from an asset or cash generating unit. It's present value, right? So it's discounted value. So when you want to determine the asset's value in use, you need to estimate the future cash inflows and outflows to be derived from continuing use of the asset and from its ultimate disposal. And it's good to do it in a table. So this table would list cash flows separately for each period, mostly a year, but it could be shorter if it's convenient and necessary. And once you have your cash flows in a table, it's necessary to select appropriate discount rate and discount these future cash flows using that rate. Some of the present values of cash flows in individual years is then value in use. And that was very simply said, but there might be challenges on how to determine future cash flows, how to determine the appropriate rates, and IAS 36 gives you good guidance on that. You can also visit our website CPDbox.com. I have published a few free articles dealing with this topic with examples on actually how to determine your cash flows for value in use. And you can find the links to these articles in the description below this video. So once you have calculated the amount of your impairment loss as a difference between assets carrying amount and its recoverable amount, then you need to recognize this loss in the financial statements. And the way how you recognize it depends on the model that you apply. So when you apply cost model for the asset under review, then the impairment loss is recognized immediately in profit or loss. For example, by debiting impairment loss account and crediting the asset, perhaps some adjustment account. But when you carry your assets under review at revalued amount, well, for example, in accordance with revaluation model under IAS 16, then any impairment loss shall be treated as a revaluation decrease in accordance with that standard. So in this case, by direct debit in other comprehensive income as in line with IAS 16 for revaluation model and credit the asset or adjustment account. But if there's no revaluation surplus in equity or other comprehensive income, then the impairment is debited in profit or loss immediately, even if it's revaluation model. And after the recognition of impairment loss, you need to adjust depreciation for future periods to allocate assets revised carrying amount, less its residual value, of course, on systematic basis over remaining useful life. Now, sometimes it's not possible to determine recoverable amount for individual asset, right? So it's in the case when the value in use is perhaps very different from fair value less cost to sell. And at the same time, it's not possible to calculate value in use for individual asset because it doesn't generate cash flows independent from other assets. So here we come to concept of cash generating unit, and that is the smallest identifiable group of assets that generates cash inflows that are largely independent of cash inflows from other assets or groups of assets. So analogically, as for individual asset, impairment loss for cash generating unit arises when its carrying amount exceeds recoverable amount of cash generating unit. But because we are not dealing with one item, but with the group of items, we must take care to be consistent. So whatever items you include in the calculation of the carrying amount of your cash generating unit, you must include the same items for the purpose of calculating recoverable amount. Now, when you're dealing with impairment loss related to cash generating units, we often come across the issue of goodwill in business combinations. That's the specific case. And IAS 36 sets the rules how to test goodwill for impairment and how to allocate impairment loss when goodwill is involved. So please check that out on our website or in IAS 36. And finally, IAS 36 also deals with so-called corporate assets. And those are assets other than goodwill that contribute to the future cash flows of both the cash generating unit under review and other cash generating units. And typical examples of corporate assets are headquarters, administrative building, or research center. And if you have some corporate assets and you're testing cash generating units for impairment, you also have to identify these corporate assets that relate to that cash generating unit under review and include a portion of corporate assets carrying amount into the carrying amount of that cash generating unit. So you would allocate the carrying amount of corporate assets into the carrying amount of cash generating unit under review. Now, the last topic I want to cover in this video is reversal of impairment loss. When you recognize impairment loss in previous period, you still need to assess whether there is some indication that the loss no longer exists or is smaller. And again, you have to assess certain indication from internal and external sources. And you can see examples on the screen. So if you find such an indication that an asset might no longer be impaired, then it's necessary to estimate the new recoverable amount. And only when there is a change in estimates used to determine assets' recoverable amount, then you might reverse the recognized impairment loss. But you cannot reverse impairment loss due to changes in assets' recoverable amount coming from passage of time or coming from unwinding the discount, all right? I'd like to mention here that you can never reverse impairment loss on goodwill, never. And other than this, the reversal cannot result in increased or revised carrying amount higher than would be the original carrying amount after regular depreciation charge. The interesting fact is that under US GAAP, you can never reverse impairment loss. So that's the bigger difference between IFRS and US GAAP currently. All right, so that was a short summary of IAS 36, Impairment of Assets. Of course, there is much more to learn and to see and to calculate. I appreciate you watching the video and I trust you learned a lot. And if you still need to learn more, get your CPD's answers to your questions, please visit cpdbox.com. Bye.